So as you can see, I'm standing behind a garbage can because I believe that this is where most of the Chinese stocks should belong. So it's a gloomy day, not only in reality, but also for many shareholders in the Chinese equity space. So across the board, there's been a lot of volatility, especially in Hong Kong today. I think Country Garden, for whoever that has been following, the largest property developers in China, currently they're down 20% today. And I think from its peak, it's down by more than, 95%. It was trading at a highs of $18 and it's currently trading at 80 cents today. Across the board, I think even for automobile companies, BYD is also down 6 to 8%, NIO, XPeng and all the friends. And more importantly, for many people that have been following Chinese tech, they have been down as well. Tencent is down 1 or 2%, Baba is down 2-3%. And I think despite coming off very great earnings on Thursday, Alibaba in the US exchange actually rallied by 5.7%. But on Friday, they have essentially gave up all the gains and it's down negative 3.5%. So I'm just going to spend some time to essentially discuss what is essentially transpiring across the Chinese equity space. And all you can do is to help me gently tap that like button because I'm braving the storm and giving you live updates. So there are three key reasons that was attributable to many of this volatility. The first one is really on the total social financing. For the month of July, it came in at around $528 billion renminbi versus the $1.12 trillion expected. I will explain a little further on why this is a cause for concern. Secondly, it's the new bank loan. The new bank loan figures that was just released, they actually fell to the lowest point since November of 2009. And it is very telling of the Chinese consumer sentiments today. And last but not least, the third point, which is there are rumors that are coming out from China where some of the trust funds are nearing defaults and some of them might even go bust as they actually delay payments. So total social financing in Chinese, it's called 社会融资总量. Essentially, it's the aggregate volume of funds that is provided by China's domestic financial system to the private sector of the real economy. Yes, it sounds like a mouthful, you don't really understand what's going on. It's pretty much a mechanism or a tool for China to manage their liquidity. Essentially, it's a monetary policy indicator where it's a barometer that sums up the total fundraising by Chinese non-state-owned entities. And it's the money offered by domestic suppliers. So after all this mumbo-jumbo, you might be asking me, hey Chiking, why is this even important? Why is it affecting the stock market? I think particularly so the indicator is not really important, but it's really the trend of where it's going and heading towards. So I think in terms of the TSF trend, it came in July at $528 billion, which was the lowest across the entire decade. And even if you were to take into account on a trailing 12-month basis, the TSF figures actually peaked in January at around $6 trillion RMB. The expected figures for July was around 1.12 trillion, but the actual figures that came in was less than half at $528 billion. And many people actually see this as some sort of a proxy for private enterprises to be lending confidence to the economy and Chinese lending by and large. But I think the second point is much more telling of the consumer sentiments today. China's monthly new loan is actually at a decade low. Yes, you've heard it right, decade low. Not yearly low, not monthly low, at a decade low. And this is half of last July comparing year on year. So it is quite telling that both household and private enterprises are essentially deleveraging. But this trend of deleveraging has actually started in 2020 when they already introduced the 3 red line policies. But looking at the trend, similarly, I don't really know what insights to gather because there is a huge amount of volatility. But likewise, I think the concerns are similar. Everyone is afraid how the liquidity crunch is going to come biting back at the Chinese economy, whether is it on an enterprise level or on a household level. And last but not least is the health of the Chinese economy that everyone is afraid of today. So investors and economists alike are essentially just second guessing and how the deleveraging in the real estate sector is going to cause second and third order impacts. So there are 2 clients of a trust company said that the firm is going to be delaying payments of maturing wealth products. So the trust industry is essentially heavily pressured by the property crisis because companies are essentially defaulting on investment products that are currently linked to property developers. And we can of course intuitively think about it as second and third order impacts in the entire economy and financial sector. So Country Garden, which is the largest developer in China today, has recently just announced that they're going to suspend trading on nearly 11 onshore bonds on Monday. And you can see why the equities of Country Garden has plummeted significantly, which was alluded in the start of this video. So they essentially missed 22.5 million on coupon payment on offshore notes last week. Now, the interesting thing is, the rumors of trust funds going bust has always been there and has started very long ago. But many of these discussions are intensified whenever there is a huge sell down, like today. So is this really the reason that is attributable to the sell-off, or is this just an excuse? Beats me. But largely speaking, I'm in agreement with Hao Hong on Twitter that this sell-off was very much triggered by a disappointment in terms of lack of concrete actions and lack of concrete support in terms of policy making to many of these troubled companies. And I think this is really interesting if you were to contrast what's happening in China today versus the US counterpart. Investors are extremely skeptical of any further concrete support that is provided by the government. It's as though they think that the Chinese government wishes the economy to collapse. I think this is just an interesting observation. I'm not insinuating anything. I'll leave it up to you to draw your own conclusions. So to round up the discussion, these are just a few of the concluding thoughts. Personally, in my portfolio today, I don't have any exposure directly related to the real estate sector. I didn't buy any property developers, or I didn't buy any trust funds or investment-linked products that have direct exposure to the property sector. But I do have a second-order impact, potentially, where I do own a few Chinese banks. They might be affected because of bad loans, bad provisions, etc., etc. But I do have a limit in terms of the exposure in my overall portfolio. And I do know that this is a very much speculative position, and you do have to risk adjust on your own personal portfolio level. And on the second point, for investors that have exposure to Chinese equities by and large, regardless of whether they're in the real estate sector or not, people will be panicking, and understandably so, because everything looks doom and gloom and bleak, and like it's raining today. Everything just doesn't go well for investors. And specifically for investors in the Chinese space, you need to stay ridiculously optimistic. Because you will have bad news being thrown at you time and time again, especially in this entire deleveraging scenario. So I honestly don't have greater insights than God, but all I can say is this. For those of you who have positions in, I don't know, Tencent, Alibaba, in Li Ning, in many of these other Chinese name stocks, it's good to have a pulse in terms of their financial results, how they have been performing. And I think for Alibaba specifically, I know that many of you have Alibaba position, the recent earnings was really a great beat. And they did introduce some level of optimism back again in the retail space. So regardless of how the property sector or how the finance sector is doing, as long as the companies that you own are fundamentally strong, they can continue delivering top line and bottom line growth. Let's not forget, at least in the long run, the stock market is a weighing machine. And if they're able to consistently deliver earnings, free cash flow, and they're able to deliver it and return it back to shareholders in terms of dividends or even share buyback, you will benefit at the end of the day inadvertently. So this is just my basic opinion on it. Yes, it's still very much narrative driven for many of these Chinese names, but for those of you who have stayed long enough, I think something like that wouldn't faze you much. With that, I'll see you in the next video, but more importantly, I will finally see you on the moon. Goodbye!